Sometimes a stock collapses even though nothing went wrong. That's not a mystery, that's dilution. Public markets are built on a simple promise: buy shares and you own a piece of the company. But ownership only has meaning if the share count is stable. Most retail investors focus on price. They rarely watch supply. That blind spot is where dilution lives. Dilution happens when a company issues new shares. The company gets cash. Existing shareholders get a smaller slice of the same pie. Dilution isn't illegal. It's often framed as raising capital, but how and when it's done determines who benefits. The setup usually starts with a struggling or speculative company. Cash is tight. Revenue is uncertain, the stock is thinly traded. At this stage, insiders, early investors, or financiers often hold shares at extremely low cost. Their incentive isn't long-term growth, it's liquidity. Next comes visibility. Optimistic press releases. Forward-looking projections. Buzzwords. Disruptive. AI-powered. Next generation. Sometimes it's hype. Sometimes it's hope. Retail interest increases. Volume rises. The stock price climbs. This is not the end game. It's the setup. As price and liquidity rise, early holders begin selling, quietly at first, then faster. The selling pressure caps price gains, but the public explanation is usually vague. Profit-taking, market conditions, volatility. Retail investors see price stagnation and assume patience is required. They don't see the supply expanding behind the scenes. Then comes dilution. New shares are issued, often through secondary offerings, convertible debt warrants, at-the-market offerings. These new shares are frequently priced below market value. The company gets cash. Insiders and financiers get exit liquidity. Retail shareholders absorb the loss. More shares mean more supply. Unless demand grows faster than dilution, the price falls. Even good news can't offset a rapidly expanding share count. This is why some stocks fall after positive announcements. The market isn't reacting to news, it's reacting to math. Dump and dilute strategies survive because each step is technically legal. Disclosures exist, filings are made, but complexity protects the system. Most retail investors don't read dilution clauses buried in filings, and by the time dilution becomes obvious, the value extraction is already complete. The beneficiaries are predictable: early investors with low-cost bases, institutions receiving discounted shares, companies that survive another quarter. The cost is spread across thousands of retail holders. No single victim, no single villain, just incentives doing their work. Dump and dilute schemes leave fingerprints. Watch: rapid increases in share count, frequent capital raises, convertible debt structures, heavy promotion without revenue growth. Price tells a story, supply tells the truth. This isn't about bad actors. It's about a system that rewards extraction over stewardship. Markets